Welcome everyone. Today we are going to be doing advanced audit and assurance, and this is basically a sequel to the other lecture I did on independence issues and the threats accountants and auditors face when it comes to auditing the financial statements. So this is a continuation, basically. This is a continuation. And so if you haven't watched the previous lecture, please do so you get the context of this lecture. That's very, very, very important. That's very, very important. So we are talking about the guidance, we talked about the ISBA code, we talked about independence issues, we talked about the threats auditors and accountants face, and then we began to dive into some situations, some situations that auditors might find themselves in, the threats that they are exposed to, and what the guidance says when it comes to those threats. So we'll be continuing today, and we'll be talking about fees, audit fees. So where fees from a particular client represent a very large portion of the firm's total fees, there's a self-interest or self-interest rate. There's a self-interest rate right here, Why is this the case? Because let's say an audit firm, let's use an example, an audit firm, ABC Company Limited, receives total audit fees of about 5 million, right? And only one client is giving them, let's say, 80% of that 5 million. There's something going on there. That's what the code is discussing here. There's something literally going on here, because in that case, there's a self-interest rate. If one person alone is giving you, a large proportion of your total fees, then that person can literally control you. That person can literally control you and can intimidate you. They can intimidate you. That's why they can create a self-interest or intimidation threat. They can say that, you know what, if you don't align with our views, we are leaving, and you won't be able to get more audit fees from us. So the code takes a lot of consideration for that. So the ISBA Code of Ethics states that for public interest entities, when recurring fees paid by one client or a related group of clients exceed 15%, please mark that number. Keep that number in your head, write it down. When it exceeds 15% of the total fee income of the audit practice for 2 consecutive years, the firm would have to, number one, disclose the facts to those charged with governance. He has to disclose it. When it's 15% of your total fee income for a period of 2 years, that raises an alert. It raises an alert, because whoever pays you more can influence you. Number 2 is conduct a review. Conduct a review of your audit fee situation, So that's basically the thought that surrounds fees, right? We need to look to see whether a particular client represents a large proportion of a firm's total fees. And for public interest entities, if it's exceeding 15% of the total fee income, then we need to disclose and conduct a review. So let's move on to the next one. Inducements, including gifts and hospitality. Inducements. What are we talking about here? Assurance team members shall not accept inducements from an assurance client unless the value of that gift is trivial and inconsequential. If the value of the gift is trivial, they can. But on a general note, assurance team members shall not accept inducements from an assurance client. If members of an audit team accept inducements from an audit client, the following issues might need consideration. Number 1, so we want to find out how material that gift is, how significant that gift is. So number 1, what we want to know is materiality. We want to understand materiality. Was the value of the inducement sufficiently large that it could affect the objectivity and independence of the audit team members? In the case of hospitality, you know, if it's a hospitality gift, was the hospitality accepted during normal working hours? These are questions that you need to be asking yourself. So what is the main point? The main point is here, on a general note, assurance team members should not accept inducements from an assurance client unless the value of the gift is trivial and inconsequential. And what do we mean by trivial? It means that if it's trivial, if it is not likely to affect the objectivity and basically the independence of auditee members. Very, very important. Very, very key. Very, very key. Then let's look at other threats. Provision of other services, which is non-audit work. Provision of other service, which is non-audit work. The independence of an audit firm might be threatened when the firm carries out a large amount of non-audit work for a company that is also its audit client. So basically, when a firm or an audit firm is providing other services that are non-audit services for a client it audits, it creates independence threats. It creates non-independent. So how does it create non-independent? How does it create independence threats? Sorry. Then the non-audit work may provide a large amount of income that makes the audit firm economically dependent on the company. So there's a self-interest threat there. So what the code is trying to avoid here is that in pursuit of more business from clients, right, audit firms might engage in non-audit work, for their audit clients. And because that non-audit work might provide them a large sum of fees or sum of revenue, it may create a self-interest threat there. And audit firms may become economically dependent on the company. And that's what the code is trying to avoid. In addition, employees of the audit firm who carry out the audit may be required to audit the work that has been done for the company by colleagues in the audit firm. It might be difficult for them to find faults with the work that has been done by the employees of the firm. So there's a self-review threat here. So for instance, in doing their work on non-audit services, a situation may arise where the employees who are auditing the clients, may have to review non-audit work. And in that case, they can, as natural as human beings are, they'll try not to find fault with their own work. And so that creates a self-review threat. So that's very, very important. Anytime a company is going for other services, this is something that should readily come to mind, because you don't want the audit firm to become economically dependent on the audit clients. Another thing is prohibition on assuming management responsibilities. Prohibition on assuming management responsibilities. Providing non-audit services may result in the firm assuming management responsibility. The code prohibits the firm from acting in a managerial capacity. Always remember this. The auditor is not supposed to act in a managerial capacity for a client, because it will create a self-review, self-interest, familiarity, and advocacy threats. There are too many threats associated with assuming management responsibility. So the code prohibits that. Very, very key. Let's move on to other situations. Preparing accounting records and financial statements. So there are situations where an auditor might prepare accounting or bookkeeping services. So let's see what that brings. Accounting or bookkeeping services, including things like payroll services, must not be undertaken for a client that is a public interest entity. It must not be undertaken for a client that is a public interest entity. For clients that are not public interest entities, the auditor may provide, accounting or bookkeeping services, but you must do so with appropriate safeguards in place. appropriate safeguards in place. And what are some of these appropriate safeguards? the service must not be performed by a member of the audit team, you know. So you must get another person to perform such services, just to ensure that the independence of the members are maintained. So accounting or bookkeeping service must not be undertaken for a client that is a public interest entity, but for clients that are not public interest entity, the auditor may provide accounting or bookkeeping services. Very, very important. Then you have temporary staff assignments. Temporary staff assignments. What does this mean? An audit client may ask an audit firm to lend to it one or more of its staff to work in the client's account department. So these are temporal staff assignments. So the audit clients will come to the auditor and say, hey, we need one of your staff to help us in our accounting department. But this creates a lot of threats. Number one is the self-review threat. So once you release your staff to the client, there are situations where your staff might have to review their own work, and that will create a self-review threat. It also creates an advocacy threat, because once you release your staff to the client, they would like to align themselves. They might align themselves with the interest of management and become their advocates. You do not want that to happen. You know, so how do you deal with it? How do we deal with it? You deal with this. The person who has been on that temporary assignment is not allowed to work again as a member of the audit team for that particular client. You know, but sometimes, you know, practically, these people might have extensive knowledge when it comes to the audit clients as well. So it creates sort of a situation. But ideally, what should happen is that the person who has been on this temporary assignment should not be allowed to work again as a member of that audit team for that client. Very, very important. Very, very important. Then let's talk about second opinions. Second opinions. Second opinions are basically created, or opinions that are provided when a company approaches another auditor for a second opinion. So it means that a first auditor has given an opinion, you know. A first auditor has given an opinion. Then the client goes to another auditor for a second opinion on the financial statement. So what should happen here in situations like this? The member should obtain the company's permission to contact the company's auditor, you know. So in that case, the member or this new auditor that has been contacted should obtain the company's permission to contact the auditor, the first auditor that gave the first opinion. So this new auditor that the company is trying to get them to give a second opinion, they should contact the first auditor for permission. If they don't get the permission, then this new auditor that they are contacting should refuse to act. He shouldn't give the second opinion, basically. Very, very important. Then you have specialist valuations. Specialist valuations. An accountant may be asked by a client to carry out a specialist valuations, which may include things like actuarial valuations, valuations of intellectual property and brands. The threat to independence is that an audit firm may be required to review a valuation that it has made for a client. So if you are working on things like specialist valuation, there might be a self-review threat, because there are times when the auditor might have to review their own work. And it will also create advocacy threats, right? Because something you've worked on, you will try to push it, you will try to promote it, and so you'll be an advocate for it. So for audit clients that are not public interest entities, audit firms should not provide valuation services where the matter is material to the financial statements. Where the audit client is a public interest entity, audit firms should not provide valuation services where the matter is material to the financial statement. So always remember, specialist valuations, things like actuarial valuations where you have to value another example is where you have to value intellectual property. It might create a self-review threats and also advocacy threats as well. And so the guidance says if it's a public interest entity, audit firm should not provide valuation service where the matter or amount in question is material to the financial statements. Very key. So let's talk about safeguarding independence. Safeguarding independence. The responsibilities of individual auditors and audit practices. The responsibility for safeguarding independence is shared between the auditor and the profession as a whole. There should be a culture of independence that is shared by all partners and employees in an audit firm. Remember one critical term in audit, which is tone at the top. Partners at the top should be committed to a culture of independence that will flow down throughout the entire organization. And so there has to be detailed rules and regulations surrounding independence. Independence must be treated as a very, very serious issue in an audit firm. Another thing is that where possible, there should be rotation of the engagement partner. You do not want to create familiarity threats. So when an engagement partner has been on an engagement for very long, it will create familiarity threats. And so you want to create a rotation mechanism where partners that move from one engagement to another. So rotation basically means that an individual should not be involved in the annual audit of the same clients for more than a certain amount of years. You should also, the audit firm should also include training. Very, very important. You should train your staff, on the issues of independence and make sure they are aware. Training is key. Also, they should implement quality control procedures. A firm should have procedures for quality control to ensure that independence is considered in respect of all work undertaken by the firm. So quality control procedures is very, very important to safeguard independence in an organization, in an audit firm. Yeah. So we've talked about responsibilities of the audit firm when it comes to safeguarding independence. Now let's talk about responsibilities of the profession. So professional bodies expect their members to comply with the codes relating to independence. So if they don't, there might be some disciplinary action, and such action might lead to things like a fine, exclusion from membership, etc. So what do they do? They suggest new practices and procedures that are certainly aimed at improving auditor independence. So they suggest things like, rotation of audit firms, the use of audit committees, avoiding close relationship of too much of familiarity between an audit firm and a client for a long period of time. They suggest things like that. So they suggest new practices and procedures. Again, the responsibility for safeguarding independence is seen as a shared responsibility, between the auditor and the profession. So both of them are responsible. It's a shared responsibility. Let's look at confidentiality and conflicts of interest. Confidentiality and conflicts of interest. We've talked about confidentiality as part of the fundamental principles. So let's delve into it a little bit. The duty of confidentiality is a fundamental principle of professional behavior that information obtained in the course of the audit or professional work done should not be disclosed to others. The auditor has a duty of confidentiality not to disclose audit information or information obtained during the course of the audit to others unless this is required by law, unless there's a professional duty to disclose. Those are the exceptions. So the exceptions are that except there's a disclosure that's permitted by law, or there's a disclosure that is required by the law, or there's a professional duty to disclose. So client information is basically secret information, except for these factors. It's the onus is on the auditor to maintain that confidentiality. Very important. Very important. Then let's talk about the confidentiality of the working papers. The working papers. So what are the working papers? The working papers are basically, the documents, that are for the auditor, that the auditor uses to basically record the work done in an audit. Those are the working papers. These are documents that the auditor uses to record the work done in an audit. So an accountant's working papers, which contain confidential client information, are the property of the auditor or the accountant, and you shouldn't make it available. Generally, you shouldn't make it available to outside parties. However, there are situations where government agencies ask to see the working papers, And in such situations, what the accountant or the auditor should do is to act in the best interest of the clients. If he feels that releasing the papers is in the best interest of the clients, and the client has no objections, then the papers should be made available. And ultimately, the tax authorities also are likely to have legislative power to obtain the papers. So there are situations like that. But the working paper is the property of the auditor. Remember that it's the property of the accountant. It contains client information, and it's supposed to be confidential. Occasionally, the authorities may ask to see a sample of work papers from a firm of accountants. This is an occasional practice. This usually occurs when they have doubts about the quality of work performed by that practice. So as a quality control measure, they would like to see the working papers to see if the auditors are doing a quality job. So let's talk about confidentiality and conflicts of interest. Conflict of interest can arise under two situations. Number one, conflicts between members and clients, and conflicts between competing clients. Conflicts between auditors and clients, and conflicts between competing clients. So let's talk about conflict between members and clients. Let's talk about that for a moment. Members of firms should not accept, or when we say members, audit firms should not accept or continue an engagement when there's a conflict of interest between the audit firm and its clients. If there's a conflict of interest between the audit firm and its clients, then don't accept the engagement. Don't accept the engagement, because it will likely affect the judgment of the audit firm. And possible safeguards here is to review your relationship with the client on a regular basis to assess if there are any conflicts of interest. And when you're taking on new clients as well, you should consider potential conflicts of interest. So there are conflicts that exist between audit firms and clients. Now let's move on to the second type. These are conflicts between, just give me a second. These are conflicts between competing clients. So let me explain this to you. There are situations where an audit firm might have competing clients. They might audit or provide services for two clients that are in direct competition with each other. So let me give an example. Let's say MTN and Vodafone are in competition with each other, and they share the same auditor. Let's say Deloitte, the same auditor. They share the same auditor audits MTN. An example, the same auditor audits MTN as well as Vodafone, So there might be situations where there will be conflict between those two competing clients. And the auditor, since he audits both of them, kind of gets mangled up in that conflict. The firm has a professional duty of confidentiality. So since the audit firm has access to information of both, and these firms are competing clients, the audit firm has a duty of confidentiality, and so does not have or should not disclose confidential information about one client to its competitor. It's totally unprofessional. You can't disclose information about one competing client to another competitor. You shouldn't do that. You shouldn't do that at all. It's totally unprofessional. Very, very important. Very, very important. So the approach that the accounting firm should take will be a matter of judgment, should reflect the circumstances of the case. Where the acceptance or continuance of an engagement will materially prejudice the interest of any client, the appointment should not be accepted or continued. So careful consideration should be taken when an auditor is going to accept engagements that involves competing clients. So let's say the auditor already has, let's say, MTN in its portfolio and wants to add Vodafone. At that point, they should be careful. They should be more aware, because when we are dealing with competing clients, it becomes a lot more complicated. But there are safeguards, and the safeguards are that, number one, I think I've already mentioned it, giving careful consideration to whether or not it is appropriate to accept an assurance engagement from a new client that is in direct competition with an existing client that you are auditing. So if you are auditing, you are bringing on a new client that is in competition with a company that you are auditing, careful consideration should be given. Then careful management of the clients. So if you already have competing clients in your portfolio, you should carefully manage them and assign different staff to these different companies to work on their audits, whatever service you are providing them. If you assign the same audit team to both competing clients, it does not help. You must assign different teams, to them, just to preserve confidentiality and promote independence. Very, very important. Now let's talk about corporate financial advice. Corporate financial advice. There are situations where an audit firm might give financial advice, but they should not do so. So certain types of corporate finance services might create such significant advocacy and self-review threats that the work should not be taken on. So audit firms shall not promote, deal in, or underwrite and audit client shares. So there are certain specific financial advice of certain financial work or certain financial advisory services that auditors should not engage in, because it will create advocacy and self-review threats. Number one is underwriting and audit client shares. That is, in capital raising situations, the audit firm shall not promote, deal in, or underwrite and audit client shares. An audit firm shall not also provide corporate finance advice to an audit client, where the effectiveness of such advice is dependent on a particular accounting treatment or presentation in the financial statement being audited. So an audit firm should not give corporate finance advice where it has some linkage or some impact on the accounting treatment in the financial statement. Very, very important. Very, very important. In other cases, safeguards such as not making management decisions, an independent review of the audits or corporate finance work, and using individuals who are not members of the audit team should be considered. So these are the safeguards. When you're implementing safeguards, one of the effective things to do is the auditor should not make management decisions. Reviews that are done on the audit should be independent, and you should always strive to use individuals who are not members of the audit team you are considering. It's very, very important. It's extremely key. Extremely key. Advising clients involved in takeover bids or share issues. Advising clients when it comes to takeover bids. There are situations where, the firm you are auditing might be exposed to a takeover. So what will be the auditor's position? Sometimes the auditor will be asked to give advice. They'll be asked to give advice. Okay. So what should the auditor do? What should the auditor do? Where clients are involved in a contested takeover bid, the auditors could find themselves in a position where they are potentially acting for both parties. So just imagine an auditor, right? He's auditing two clients. The first client, or client A, is seeking to overtake client B, which the auditor is also auditing. Very interesting situation. In such a situation, there's a danger that the firm cannot give objective professional advice. So because he's auditing the same, these clients, one is taking over the other, but he's auditing both of them. Just imagine they come to the auditor for professional advice. The auditor might not be objective, or the audit firm might not be objective. And another thing is that there's a confidentiality risk here, because the firm might be in possession of confidential information relating to each party. And so it might pose a possible breach of confidentiality. So that's something to watch out for. So what are some of the guidelines in this area? In principle, it is not bad that an audit firm will ask for both parties in a contested takeover bid. However, a firm should not be the sole or main advisor to both parties. The audit firm should not be the sole advisor to both parties. If the accountants are in possession of certain confidential information and feel that their position in this respect is questionable, they should take advice from a regulatory authority. That's why regulatory authorities are always there, so that audit firms can go to them in case they have situations that, are bothering them, or situations that are above them. So in advising clients, very, very important when it comes to takeover bid, there's a danger that the auditor might not give the objective professional advice, especially when the involved parties are the audit firm's clients. And there's also a danger that there might be a possible breach of confidentiality. So that's always something to look out for. And basically that's something to look out for. And this is the end of today's class. Thank you very, very much for joining me. Please subscribe to the channel if you haven't. I upload ICA lectures, ACCA lectures, CIMA lectures, all kinds of, basically everything to do with business here. So please subscribe, hit the notification bell so that anytime I post a video, you'll be the first to get it. Thank you and have a good day.